Our next guest says that the Fed will send a strong signal that tapering will begin this year, but that she's not expecting a rate hike until the second half of 2023. Joining us right now is Julia Coronado. She's president and founder of Macro Policy Perspectives. And Julia, let's put this into context of what we're seeing today, with the Dow indicated down more than 500 points this morning because of concerns about this property company in China and the potential financial implications of that. Obviously, it's big news in Asia, but there are some U.S. companies that have some risk exposure here, too. And I guess if you put all of that together, what does that mean? The data we got last week was good, but then you look at a potential financial contagion, and that's a whole different ballgame.
Oh, absolutely. I mean, if we got persistent disruption to global financial markets coming out of China, that would be a big deal. And of course, the Fed is going to retain some optionality. So we expect what the Fed has referred to as advance notice, which is an indication in the statement that tapering is likely to begin this year if the economy unfolds as expected. But if the global economy looks shaky, that would be a reason to push back. Of course, because we don't expect the actual tapering announcement until November. So that gives the Fed plenty of time to evaluate the global situation, both the Chinese situation with regard to the deleveraging that it's going through now, but also the Delta variant and the sort of havoc it's wreaking on global supply chains and global economic momentum as well, which is very important.
You know, it's hard to imagine that a Chinese property company could really cause ripples that would impact our markets, too. But Evergrande owes $300 billion, and the Chinese government is making noises that they might not step in to help that company out. President Xi talking about common prosperity and not wanting to kind of encourage risk-taking like this in the private sector. So how do you kind of think through this, and how big of an issue do you think it could be for us?
Well, I think it's a symptom of a much broader issue, as you suggest. I mean, China's been implementing a lot of structural reforms, and the bottom line from that seems to be, for the global economy, that China is not going to play the role it played last cycle, which is the engine of global demand. China was the leading indicator of ebbs and flows in global demand throughout the last cycle. And they would, when the economy wobbled, it would step in and stimulate. And we sort of rode those waves of stimulus one after another up and down. That's not going to be the case going forward. China's going to settle into a much lower rate of growth. And so the global growth dynamic is going to be much more balanced and at a much lower level on an ongoing basis. So, we've been kind of riding a huge wave of U.S.-driven stimulus. The whole global economy has. That's also fading. And we don't know exactly what the dynamics are of that. How much will consumers hold on to their savings? How much will they spend? And so we're still at a very unusual, highly disrupted, very uncertain inflection point in the U.S. global economy. So while things have been going really well on balance, sort of from a macro perspective in the U.S., there's still a tremendous amount of disruption from the pandemic and from shifting global relationships and supply chains. And so this is all of the forces that the Fed has to sort through, and it's not a simple picture. So whatever they decide or signal, there's going to have to be some flexibility and some ability to sort of steer the ship as these dynamics evolve.
What does the Fed have in its toolbox at this point? I mean, we've done so much. The balance sheet is so big at this point. We haven't reined it in while the markets were kind of flying, while the economy was flying, while we were looking at global growth pictures. If it turns out that this is a bigger deal, if it turns out that it's a signal of China not growing as quickly, not maybe adding as much to the world economy, what can the Fed do?
Well, some of that is structural, and the Fed doesn't need to address. I think that's one of the reasons, for example, we've continued to see very low interest rates around the world, is a recognition by investors that the medium term, you look through this current stimulus impulse, and the medium term outlook for the global economy is much slower growth on a structural basis, on a demographic basis, et cetera. So that's not something the Fed needs to correct. I think the lever of continuing QE or tapering more slowly, that's not nothing. You know, that's a pretty powerful, they're still injecting a tremendous amount into the global capital markets every week, every month. So that serves as a decent insurance policy, again, depending on how deep this goes.
Shepard Smith here. Thanks for watching CNBC on YouTube.